Morning, ladies and gentlemen. Morning, those of you that are in this beautiful theatre we have, thanks to Fender Geophysics, who are the sponsors of this theatre. My name is Kerry Stevenson. Some of you know me as the host of Making Money Matter. I am also the founder of the Australian Gold Conference and Gold Coast Gold. Great to see you all this morning. Very, very, very topical today, ladies and gentlemen, because we are going to be talking about gold, my favourite subject. Good morning, Mr. Morrow. Gold as an investment vehicle, but also the implications of continuing price increases. But I've got a panel of much smarter people than me to come up and join me on stage. So without further ado, let's start off by welcoming my first panelist, Michel Mamet. He is the founder and chief investment officer for the Gold, Energy and Resources Alpha Fund. And you can call that GERAF. Please welcome Michel. Next up, I have Jordan Eliseo. Jordan is the general manager of ABC Bullion. And if you don't know where they are, right opposite, they've got, have you got the 400 ounce bar here? Maybe, yes. They have been, you do have it, Alex? Good. Go check out it. It's only worth $2.5 million in today's prices. Next up, we have Alberto Migliucci. He is the founder and chief executive officer of Petra Commodities. Please welcome, based in Singapore and Sydney. And last but by no means least, please welcome Alex Scanlon, founder and CEO, managing director and CEO, I should say, of Barton Gold. ASX code is BGD. Welcome, gentlemen. All blokes. Never mind. Christy, all blokes again. We're used to this. I'm going to start off. We don't have a lot of time. And if you've got a burning question, put your hand up, shout out, and we'll try and answer as well, because I love these discussions to be interactive, and I want you guys to learn something about it. Right now, as I stand here chatting to you today, you know, there was a bit of a pullback in the gold price. Don't know what happened there. In the gold price on Friday, impacted a lot of the equity prices on Monday morning. But today, as I speak to you, the gold price is 4,356. Now, in Australian dollar terms, that's 6,688, which I bet, Alex, means that your 400 ounce bar is now more like $2.8 million. But what I'd love to know, and let's start, Michel, I want to start with you. Is this just a cycle, or are we looking at a structural change, a disconnect, if you like? Because there's a lot going on out there in the world. We're talking about geopolitical risk. We're talking about the weaponization of the US dollar. Everyone talks price of gold. I want to talk about, is this a structural realignment, if you like?
The big question. No,
Don't
mess around.
Well, because we don't have a lot of time, so let's get straight into it.
No, good question. Look, I guess there's two schools of thought.
Yeah.
You know, there's one school of thought is that, and if you look at the data and you look at central bank buying, what you'll find is over the last 25 years, really since the GFC, there's been a reset in the level of central bank buying.
Absolutely.
And so if you take that view, and if you look at the geopolitical events that we've seen with Ukraine, Russia, and the weaponizing of the dollar, and then all the concerns around the deficits, then you can make a very strong case that there's a shift in the financial system that's occurring. It'd be good to pass that over to a few of the other guests to talk about that, because we had a good discussion about it beforehand.
Yeah,
but that's one school of thought that exists.
That's one school of thought.
The problem with this school of thought is that we've all lived in commodity cycles. I've been a professional for close to 30 years. We've seen cycles, and so you can never get away from this fact that there are cycles, and you've got to be careful thinking that things are different this time. So I think you've just got to approach it quite cautiously is the way I'd think about it.
I can see Jordan Eliseo nodding. And by the way, who's been down to the ABC Bullion shop in Martin Place? Been there recently? The queues are ridiculous. It's like no one gave it, I won't swear, no one gave a crap when gold was at 1,800, but now that it's topping out at 4,600, they're all hysterical. And seriously, they're lining up for hours. Jordan. I know, and thanks for being here, because I know how it's insane.
It's busy.
Question, structural shift or cycle?
I think it can be both.
Both?
So, yeah,
okay.
in the sense that I saw a great comment a couple of days ago about gold, that it might be tactically overbought, but it's still strategically underowned. And I think that's probably a pretty decent way of summarising where we are. If you look at a handful of technical indicators, the price has really run quite far, and it wouldn't shock to see a bit of a corrective period. But at the same time, if you look at gold allocations within diversified investment portfolios and the like, they're still very modest by historical standards. Or if you look at gold share of overall global financial wealth, so the market value of all the gold, market value of all the stocks, market value of all the bonds in the world, gold's share of that pie, as it were, is still quite modest relative to historical averages, and certainly modest relative to genuine tops in gold cycles. So I think two things can be true. I think that part of this is a cycle where gold is, just the hottest thing on the market right now, and maybe that needs to cool down a little bit, but that actually this is part of a broader cycle where, gold is going from something that almost no one wanted to own to something that everyone feels they have to own.
And just before I move on to Alberto, how is ABC Bullion handling the demand? Can you keep up? Because I've heard talk about certain supply shortages in the market. Is that impacting delivery at the moment?
Look, we're incredibly blessed. Obviously, as I'm sure many people in this audience would know, ABC is just one of several companies that form part of Bullion Group, and as it relates to bullion supply, ABC Refinery, located here in Sydney, is by far the largest independent refinery in the country. Does more than 85% of the silver, does about half the gold as well now. So we're talking hundreds of tons of both gold and silver refining capacity per annum. So we're in the perfect position to be providing to the market. And I mean, just as a way of illustrating, I won't talk about us for now. If you look at other businesses around the world, some of them have even had to put digital queues to even access their websites to log in, right? Others have completely shut up shop. They're just not dealing with the public anymore because they just can't deal with the demands.
Yep.
It's very much the ethos of our company that, we really strive on rising to the challenge. So, we've extended our trading hours. Our team is doing, literally morning, noon and night shifts to try and get back to as many client inquiries as we can. I think everybody would appreciate we can't respond as quickly as we normally would to each and every inquiry, but we are working literally around the clock. And that's not just bullion, that's all of the parts of Bullion, including the refinery that obviously manufactures the stock. So, how are we dealing with it?
But supply, you're okay.
We have plenty of stock, yeah.
Excellent.
Yeah.
That's all I needed to know. Excellent. Alberto, question for you is, bit of hysteria down here, lines outside ABC Bullion, but you spend a lot of time up in Asia, predominantly Singapore. Is it a similar outlook up there?
Good morning. Can you hear that? Good morning.
Morning.
Morning. Okay. Is that
It's
on?
on. Yeah.
You know gold's hot when someone breaks into the Louvre and in 7 minutes doesn't steal a Mona Lisa, but steals a gold crown. If gold was about $300 an ounce, they probably would have bypassed those crown jewels, that gold, and gone straight for a Van Gogh or a Da Vinci. But so gold's hot. But back to your question. Look, gold is in Asians' DNA. Back to the structural shift.
Yep.
If you look in the late 90s with the Asian financial crisis in 1997, when all the most of the Asian currencies collapsed anywhere between 40 and 80%, the Thai baht, the Indonesian rupiah, the Korean won, the Malaysian ringgit, they all dropped close to 50, 80%. Those who held gold actually didn't lose any money, but actually probably made money against that local currency. So that's still etched in the Asian psyche. If you held gold during the Asian crisis and the Indonesian rupiah went down 80%, your value against gold or rupiah increased 500%. And if you had the Thai baht, it increased 80% against the gold price. So people don't forget that. So back to Asia, I've lived in Asia for 20 years. When I was banking there, we used to, especially in places like Vietnam, you could actually buy a house in Vietnam with gold, and you use gold as a mortgage or as a deposit. So that shows you it's in the cycle. Those countries with unstable currencies, they trust gold because gold is stable. So when your currency is unstable, gold's the best place to have your money in. In Singapore, for example, you can go to an ATM machine and buy a gold bar. Right?
Gotta love that.
That's pretty amazing. And you probably also know at Costco in the US, a year ago, there was a bit of a run on gold bars. Costco was selling gold bars. But it's interesting, you could go to Singapore and just buy a gold bar. So it's very much, there are the queues also in Asia, especially in places like Vietnam, Thailand, Myanmar, these countries where they probably don't trust their currency. The Vietnamese dong in Myanmar. So gold is the place to go. I think it's very much a function of currency. So the US dollar is the worst currency in the world, apart from every other currency in the world.
It's the best horse in the slaughterhouse.
Yeah, that's right. So the US dollar is not doing that well, but every other currency is not doing well at all. So I think has created a bit of a run on gold, because when currencies go down.
I think people are starting to wake up.
Yeah, exactly. And so I believe that with this current turmoil in the market, gold thrives on uncertainty and instability. There's uncertainty militarily, right? Military-wise, uncertainty, economic-wise globally, with tariffs and that, and also social unrest. So these three pillars are actually creating a gold perfect storm. And we'll touch on it, I'm sure, later, but central banks hate uncertainty. So I'll leave it there because we'll talk about this later. But
Well, Alex, as the Managing Director of Barton Gold, working in South Australia, let's go back to that comment I made at the start. Is it a cycle?
Yep.
And clearly, in your position, you're liking these higher gold prices, and silver, of course. But is it a cycle, or are we seeing a structural realignment globally?
Yeah, so I favor the interpretation that we're in a long-term structural reordering of the global monetary system, and this is my background is that of macroeconomic analysis and investment. So developing Barton Gold or establishing Barton Gold was actually making a long-term bet on infrastructure leveraged metal in the ground, where we thought we could also grow it and then benefit from the uplift and exposure to the gold price. I think the challenge in this question is that, there are many famous sayings that go something to the effect of, long-term trends being obscured by short-term noise and volatility, right? And markets, as we think of them in metals markets, are the intersection of multiple different cycles, right? So a demand cycle brought about by, demand pulse brought by a shortage, which brings a capital pulse, which brings a development pulse, which brings a production pulse, which brings up production and brings prices down. And then prices go down, and then people stop investing, and there's a shortage, and then prices go back up, and this cycle repeats, which is why we see this cycle in metals and mining. But that sort of typical cycle, I think, ignores the broader truth underlying what I believe is the truth underlying gold today, and that is that we have reached a tipping point where 50 years of marginalizing gold by essentially creating the dollar as gold, synthetic gold in the 1970s. 50 years of marginalizing gold in favor of the dollar is now being unwound, and it's being definitively unwound, and we're seeing events on the surface now telling stories about what's actually been happening for the past 10 years. The little kids geopolitically are now the angry teenagers, and they've banded together around China, who is now one of the largest gold producers in the world, has far more gold than they publish officially, buys far more gold than they publish officially. They have mounted for the first time the first credible, sustained, and successful challenge to US dollar hegemony. as energy markets go, so too all markets will go. They have successfully de-dollarized a very significant portion of energy markets, and the news a few weeks ago, or 10 days ago, that BHP is going to be forced to accept 30% payment in yuan is essentially the expansion of de-dollarization. Iron ore is basically the second largest market in the world, and that's a sign that this is, de-dollarization is spreading. So if we are returning to a world where everybody doesn't want to have so many US dollars because of, I guess the political disincentive.
So they weaponized it.
Well, yeah, I mean, I cannot understand the policy response to try to dissuade conflict in Ukraine. The specific tool that was used, I think, was clumsy. I think it was hasty. It was foolish. The U.S. did the one thing that probably has most catalyzed the acceleration away from U.S. Treasuries and dollars by essentially weaponizing the U.S. Treasuries and telling the world that if we don't like what you're doing, we'll just delete your serial numbers.
Absolutely.
Right? So
yeah.
We are in, I think, a period where many nations around the world who maybe tolerated the US dollar-driven system and therefore had to then adhere to US banking regulations, which are incredibly onerous, are now saying, well, China's emerging as a second opposing currency pole. China is a second net issuer. China can do things for me. The US appears to be a less reliable long-term ally than I thought they were 5 or 10 years ago. I'm not going to stand against the U.S., but maybe I'm not going to stand so close to the U.S. And that being the case, maybe I don't want to recycle all of my trade surpluses into U.S. Treasuries. I'm going to be trading with people who also don't want so many U.S. dollars. Really, the driver for me here is that markets are returning to multi-currency settlement, and markets are basically giant organized bartering systems with pieces of paper we use as temporary IOUs. Markets are going back to exchange and swap platforms. People are settling smaller amounts of actual currency, and people are starting to net settle gold. So I think that's the long-term driver. I think gold has a long way to go before you take consider the de-dollarization or the demonetization of gold and the amount of currency that was printed behind that at the same time. I think that gold has to find some natural equilibrium as a proportion of the tradable market. And the real question for me is, with the money supply being somewhere like 20 to 50 times what it was when gold started being demonetized, how much of that has to find its way back in as well? I think this is a long-term trend. I think we'll see short-term volatility based on short-term reactive responses and expectations that this is cyclical. But I think this is much more structural, and I think that's pretty clear.
Michel, I can see you'll go. Let me add it.
No. Well, look, I think it's a pretty balanced conversation. I think.
Well, let's unbalance it then.
And it's very difficult to make predictions about the future because I think as soon as you start doing that, you're going to be caught out. But I agree with Alex. I mean, the reset with Ukraine was a major shift in the markets, and you can see that. I always like to look at sort of long-term data when you're forming a long-term thesis. And like I started off saying, if you look at central bank buying, you'll see a step change that occurred post GFC. It really went from sort of negative net selling to positive purchasing of about 400,000 tons.
So we're doing central banks going from net sellers to...
Correct. So a big swing. You saw a really big swing in the marginal purchaser of the product, essentially, alongside ETFs. But you also then saw another step change post the Ukraine invasion, and that lifted up to about 1,000 tons per annum. And so that step change in demand in a market that produces 4,000 tons a year obviously results in a step change in the price.
Yep.
And so I think that geopolitical event is one of the really big drivers that we've seen in the last 3 to 4 years.
So how do we look at the role of gold, I guess, as a measure of value? Given that I tend to see that people are starting to distrust currencies. And it will be interesting to see whether or not we move and shift. But how do we measure the value?
Well,
because I know you look at it from a much more macro outlook.
I'm an investor investing globally in high-quality companies that have exposure to gold, energy and resources. So I've got a general view that commodities are undervalued. And I've also got across the board. And I've got a view that why is one of the three pillars in GERAF centered around gold? Because Essentially, gold has been the best performing commodity in the last 25 years, if you look at the absolute performance.
Yep.
And it's also got a bunch of characteristics that are really valuable when you build a portfolio. And the biggest characteristic is that it actually it's got negative correlation with the market. So if I was building a portfolio and I said to you, I wanted to create a product for investors where you could get exposure to an undervalued asset class like commodities, and it actually goes really well when the market does poorly, you'd think I was pulling your leg. And that's essentially what gold does. And so that's why gold is the first pillar of the GERAF strategy. And we've seen that play out. Maybe right now in the short term you haven't seen that because we've got very elevated equity markets. NASDAQ's at all-time highs. Gold price is also high. It's quite unusual. You don't usually see it behave that way. But, you know, in the long term, that's essentially what you see.
It was interesting what you said a moment ago, because, I mean, this is mainly a gold panel, but you said right across the board for commodities. What's driving that? I can ask you, Michel, and if anyone else wants to jump in, let's start with you, and then I'll go to Alberto.
Look, I think I think markets go through long-term cycles, and I think if you look at the mining industry, the mining industry's been under attack for at least a decade, and I think that's led to starvation of capital in the industry. And when you don't invest in an industry, you tend to see a shortage of new supply coming on board.
Very good point.
And then if you sort of step back and think about metals, this whole greenification, electrification, modernization of society, it all requires more metals. So you can't have a world where there's a step change in demand and declining supply and not see price movement. So my view is it's long-term cycles, and it's just, and
we're just at the beginning.
Correct. And you can measure that, and obviously I have measured that.
It's a great time to be alive.
It's very exciting.
I know Alberto's chomping at the bit there. All right, off you go.
Thanks, Kerry. So, look, as a geologist, former geologist and now investment professional, it's getting harder to find gold, as you all know, right? Exploration costs are becoming higher. To find gold, you've got to go deeper. It's in more difficult jurisdictions, so lower grades. So you've got a rising demand, as we've seen, whether it's central banks buying or retailers, and a supply. I wouldn't even say it's rising. Apparently it's only grown a few percent in the last few years. It's interesting that in the last 10 years, no new gold discovery has been in the top 30 largest gold discoveries around. So we're not finding the big elephants anymore, but the gold demand is there. And so I think there's going to be this is why one of the reasons why the gold price, supply demand, commodities dynamics, apart from the central bank, which is the 800-pound gorilla in the room, but we're actually it's becoming harder to find gold. Obviously at a conference like this, there's a lot of gold companies which give you a high beta in terms of investment. Once the gold price goes up, some of these guys with a few discoveries, good management, can give you 4, 5, 10 times the gold price value. So that's where there's obviously opportunities. In terms of, you mentioned earlier, Kerry, gold as a value, as from a monetary point of view. Well, money measures value, right? Just like a scale measures weight, or a clock measures time. So if money measures value, but that money keeps on changing, like with the Fed Reserve, with interest rates, you don't know what's happening. And that's the most important thing in terms of, I don't want to bore everyone here with monetary policy, but that's what's happening. If your money is a measure of value, and that money keeps on changing every quarter when the Fed decides to raise or lower interest rates or manipulate the markets or monetary policy, it's like, imagine if the Federal Reserve was in charge of a clock, right? what would the minute be today?
Going back to Hedley Widdop's clock.
Yeah, exactly. So that's the problem. It's that uncertainty and change in monetary policies by central banks around the world that's creating this, let's go towards stability, which is gold. And it's like I said, it's against any other currency, it's doing well. So it's creating that stable thing. The other one is Bitcoin. Like there's a flight to gold price is high. I know Kerry we can talk about this forever, but gold price, silver, and Bitcoin, and they're actually all cries for help. They're all moves to stability. My view is Bitcoin is big tech's cry for help, cry for stability. Because that's why Bitcoin is around, because they've realized that they can circumvent other currencies.
Well, it's decentralized, yeah.
So it's decentralized. So Bitcoin is big tech's cry for stability, just like gold is a cry for stability and silver.
Jordan is one of the people that I love to listen to. You've been a long-term proponent of gold as part of a portfolio. Love to hear your thoughts. I mean, I remember when you first started talking about gold and people looking at you going, I'm so not interested. And now you're like, well, there we go, ladies and gentlemen. What's your view at the moment?
Yeah, I mean, definitely the view around gold from, let's call it, mainstream investors, asset allocators, fund managers has changed. So I've been an investor in gold since the early 2000s, sort of in the aftermath of the tech wreck. Sort of became, I mean, it's easy with the benefit of hindsight, but I didn't know, but I felt gold looked pretty cheap, and so and obviously been lucky to be largely proved right over that time. You know, back in the early 2000s in London, if you worked at a funds management house and said that you bought and invested in gold personally, people sort of looked at you funny, like, why on earth would you do that? And especially if you said you bought physical gold rather than, you know, just a gold mining share, or at the time ETFs, which was starting to be launched on the market.
Yeah.
Wind forward to when the global financial crisis hit, and people were not necessarily turning to gold. This is within the professional investment management community, but they started to become gold curious, if that makes sense. But then I think they felt like they'd missed their run, because by 2011, I'm talking US dollar terms here, prices topped out around, you know, $2,000 an ounce, $1,900 an ounce, and actually went into this little cyclical correction. And of course, that was the time that the S&P, and it seems amazing now, but go back and look at your charts. The S&P was below 1,000 points back then.
I remember, yeah.
You know, it's 6x since, or even more. So, you know, that's sort of how the cycle's changed. Brexit and Trump winning in 2016 helped put gold back on the map again. But even then, you know, the Aussie dollar gold price, it kissed but didn't even hold $2,000 an ounce in 2016. So that's less than 10 years ago. Subsequently gone on to triple. I actually think what we've seen now in the last couple of months is the genuine awakening or broadening of gold into a mainstream investment again. Now that's not to say everybody's going to buy. There was actually some really interesting research published by Fender, who do like a lot of consumer surveys here in Australia, and they said something that I think is probably pretty close to the mark, where they said, despite the fact interest in gold and searches for buying gold is skyrocketing, and I can attest to that with the demand we're seeing at ABC Bullion, what Finder said was that only 10% of Australians, or maybe it was 9%, think now's the right time to invest in gold or other commodities. Now, the proper top of a bull market cycle, that number will be more than 50%, right?
Wow.
Like everyone's gold curious now, which is different to say everyone's buying now.
Right.
So, yeah, that's sort of how I feel the market and broader investment sentiment towards gold has shifted, but there's still a lot of asset allocation into gold that can come.
I might just add a little bit to that. I mean, if you're trying to look at some of the momentum indicators, two others would be the allocation to gold. So if you look at family offices or institutional allocations, they're around 0.5% to 1%.
They're still not involved
so they're
very
still
much.
Really at the very early stages of that participation. And then if you look at the mainstream investment banks, which hopefully don't represent the top of the cycle views, but usually they're sort of more mid-cycle. You've seen all the likes of Goldman's, Morgan Stanley, all the big investment banks are coming out now with lifting of their gold price forecasts, and importantly, an inclusion of an allocation to gold. So you'll see this new portfolio of 60-40. Yeah, that's it. And so I kind of look at those indicators, if I think of momentum, as sort of mid-cycle indicators. But they make me very cautious, because I just have this natural inclination to think about cycles. So.
I agree.
That's a good point. When I was banking 10, 15 years ago, if someone came up to your private bank and said, how much should I put into my portfolio in terms of gold, invariably it was like 5%. And actually, lately, I've heard people say 15 to 20%.
I've heard 20.
So now it's asset allocation as part of your bonds, your equities, your art, and now you put 20%, 15, 20%. I think even Jamie Dimon said that recently, and he's not a gold bull at all.
That's right, he did.
He's one of the most anti-gold guys, investment bankers you can get, and he actually commented 15 to 20%.
Yeah, a bit of a step change there. Now, Alex, I know you've got Barton Gold, but you talk to a lot of funds, you talk to a lot of the institutions. Are you hearing different narrative around what they're looking at, and are they starting to pay attention now, or are you still seeing a bit of reticence even with this strong market?
Well, a lot of the funds that we spend a lot of time talking to are very gold-specific investors as well as commodity generalists. And then there's sort of generalist funds. And I think if you sort of start going back to your original question about commodities and commodity revaluation and actually start at the generalist fund end of the spectrum, these guys and girls watch very long cycles play out, and they're looking for relative changes in markets. And so I think there's a general acceptance that commodities seem very, very, very underpriced to wildly inflated tech valuations. So if you start there,
Yeah.
I think there's a general acceptance of this. Where you move into people who are more commodity specialists, they start trying to ask which commodities are going to move the most, fastest, bestest. And then if you're talking to gold investors, you tend to be talking to investors who are sometimes very multi-generational investors. I would say that commodity investors haven't yet become gold investors. There are those who have always been gold investors, and they have a mandate. The biggest gold investors for the past 20 years outside of central banks have been basically family offices that have fifth generation capital, and there's somebody alive in the family who remembers the time they had to pick up and leave while their house was getting bombed in Central Europe.
Yeah.
So, there's sort of an adjustment phase that has to happen as people kind of re-educate themselves around commodities and gold. I think back to the theme of de-dollarization, if that theme is correct, and it is because we can see it happening, all commodities should experience a lift, right? And that is going to have a bit of a kicker because we're now seeing a much more urgent emerging geopolitical competition for all commodities. So governments are now essentially monetizing commodities by essentially, the U.S. is now buying into assets. It's the first time the U.S. has adopted institutional metals or industrial metals monetary policy in decades. This is what you see in a wartime economy, right? So governments putting money into mining assets to feed the defense industrial base. So there's going to be a general kicker. I think the question of gold versus all other commodities it's a question of ratios. We obviously know the arguments about scarcity of gold and scarcity of certain metals. If markets are de-dollarizing, if people want to hold fewer dollars, they have to have a new pressure release valve for all this demand. And you can take this right back to sovereigns, so countries. If they don't want to hold so many dollars and they need to put their money somewhere, they need somewhere that's a dense enough store of value that they can actually rely on it and store it and move it and use it in trade. Gold obviously presents that, has those features. And it's also, there are other metals that may be substitute metals. And they may, diversify their exposure into other things. But oil is no longer that thing that had to be invested in. It's no longer sort of the sponge for monetary inflation because U.S. dollars are no longer the sponge for monetary inflation. I think one of the points, just to finish with that, is we have to remember that if gold is bouncing off the bottom and finding some new equilibrium, if markets are then continuing to de-dollarize, there's the question, there's sort of no limit to how far gold can expand in terms of its requirements. Markets continue to grow, demand continues to grow, central banks continue to have, countries continue to have surpluses. So we've said a lot about central banks. The most important point about central banks and central bank buying is these are policy buyers. They are not price buyers. They are not like you and I. They are not like everybody in the audience. They are not lining up to buy gold because it's of a value that is attractive to them.
Sheet. Yep.
I have $200 billion surplus today. I want to put 40% in US dollars, 30% yuan. I'm going to buy energy futures, and the rest goes into gold. And it's going into gold at whatever the asking price is. It's a policy decision, not a price decision. And that is an inestimably large tailwind behind the demand features for gold and the price features for gold.
And if we look at it from a historical point of view, this is only such a short period of time that the central banks are making their move from being net sellers to net buyers. You know, there's been a big change in that. But one of the things, we don't have a lot of time left. I did want to ask this because it can be volatile, and silver market can be even more volatile. But from the panel, some effective risk management strategies that people should keep in mind, because I think that that's important. When you're looking at a portfolio, risk management should be part of it. And, you know, I'll look to you, Jordan, first, because I'm seeing all these people lining up outside Martin Place, pretty hysterical, quite frankly, and only because if they've got this FOMO, haven't they? And again, I said it right at the start. They couldn't give a crap when it was 1800, but now that it's topping out, they're all getting hysterical. So I'd like to talk effective risk management strategies to calm people down and go, all right, how do we manage that?
Yeah, so a couple of comments on that. Firstly, the lines that you see outside our store, not just at Martin Place, but nationwide.
Yep.
Number one, it's kind of only the tip of the iceberg, because the number of people transacting online, number of people transacting over the phone actually dwarfs the number of people that are coming into the stores. But as it relates to your comment on FOMO, look, for a certain segment of our clientele, that is definitely true. But actually, the amount of metal that we're buying back from clients who are actually cashing in is running at, if I look at what we buy back now, it's about the same as what it was last year. And last year, those numbers had effectively doubled from the previous years. Wow. So there are plenty of people that are, whether it's from a risk management at a portfolio level, whether it's to pay down some debt, whether it's just like, hey, I'm going to go on a holiday with the family and I can sell an ounce and there's an extra $6,000 in my pocket to, you know, spend on the kids while I'm away. Can I just
interrupt you briefly?
Plenty of people are selling as well.
Are they selling physical metal, or are they doing the scrap? Are they doing the jewellery?
No. With us, it's people walking bullion in. And absolutely. So there are, don't get me wrong, more people are buying than selling right now, but there is an extremely healthy two-way market in bullion. And that's one of the beauties of bullion, because it is so liquid. But, you know, as it relates to your broader question around risk management, I think the sort of time-honoured principles are sensible, or should still be followed. Have a think about your overall portfolio and what that allocation should be. So, you know, you commented before, the Morgan Stanleys of the world now talking about having 60-20-20 portfolios where 20% of the money's in gold. That aligns with, if I look at our SMSF trustees as a segment of our clients, we survey them very regularly. What percentage of your portfolio are you putting in gold? And we give them buckets they can pick from. And for the last few years, we've been very pleased to see every single time the number one, or the most popular number, is the 10 to 25% bracket. So there are some that are going in more aggressively, there are some that are more modest, but people are beginning to think of gold as part of a portfolio, which is a really healthy part of where we are in this cycle.
Alex, did you want to make a comment?
Yeah, look, honestly, I would say that the best way to avoid risk in your portfolio is do not introduce additional risk in your portfolio. And
what was that?
The best way to avoid risk or risk mitigate is don't add more risk in your portfolio, right? And one of the simplest ways to do that, for the love of God, do not leverage your commodities bets. We are seeing more and more and more intra-period volatility on shorter and shorter cycles of metals markets. The gold price will hit a record 1 minute, it'll fall back $50 the next minute. Gold price equities will drop 5%, they'll be up 10% the next day. You can be right over a week and wrong inside of a day and lose your entire position if you've leveraged your bet. So I would say back away from exposure to leverage when you're thinking about these things, because in reality, you know, the best traders in the world are not trading movement, they're trading volatility, and you're trading against them, and you can't beat that. So just be cautious in that regard. We're in for a lot of volatility in the medium term.
You've got 10 seconds.
Very quickly,
10 seconds.
I'd probably say a couple of things.
Yep.
Time horizon. If you take a medium-term time horizon, you can sail through the volatility.
Yep.
2, buy quality. If you buy quality businesses, really this is just volatility, intra-period volatility. and just avoid really risky balance sheets. And that'll put you in good stead.
Ladies and gentlemen, I think it was a great panel. I hope you got some value from this morning. Could you please thank our panelists? Thank you, gentlemen.